Green hydrogen has attracted extraordinary attention, with projects announced across Europe, China, the United States, Australia, Africa, Latin America, India, and the Middle East. But announcements alone do not tell us where investor money is actually moving. Some projects have secured grants. Others have attracted strategic equity, concessional loans, or government support. A much smaller group has reached financial close, entered construction, or begun operating. In this presentation, we follow capital through the hydrogen economy. We examine who supplies the money, where it is concentrating, which technologies attract investment, and what separates a proposed project from genuinely financed infrastructure. The headline conclusion is that green hydrogen capital is still growing, but investors are becoming much more selective. Money is concentrating around projects that demonstrate credible industrial demand, access to affordable renewable electricity, strong sponsors, and visible government support. Investors also want land control, permits, water access, infrastructure readiness, and binding or near-binding offtake. Projects that lack these fundamentals may remain in development for years, regardless of their announced size. This does not necessarily mean the hydrogen market is collapsing. It means the market is moving beyond broad ambition and into a period of stronger commercial discipline, deeper due diligence, and greater emphasis on execution. The numbers show both growth and constraint. Low-emissions hydrogen project spending reached approximately $7 billion in 2025, nearly twice the previous year, and spending was expected to exceed $10 billion in 2026. The project database behind this analysis contains 2,942 track project rows and more than 1,000 gigawatts of announced pipeline capacity. Yet only 213 projects, representing about 19.3 gigawatts, were classified at final investment decision or construction. Operational projects represented about 4.3 gigawatts. Venture capital also weakened, falling to approximately $1.3 billion in 2025. Capital is growing, but mature deployment remains limited. A major source of confusion in hydrogen investment is a failure to distinguish between financing stages. An announced project value is not the same as approved funding. Approval is not the same as a legally committed investment. Commitment is not necessarily financial close, and financial close does not mean the entire amount has already been disbursed. At the widest point of the funnel are thousands of announced projects. As technical, commercial, environmental, and financial risks are tested, the number narrows. Only a fraction reach signed financing, draw capital, begin construction, and become operating infrastructure. Understanding this funnel is essential to measuring real investment without double-counting headline figures. Capital in green hydrogen must finance far more than an electrolyzer. A functioning project may require renewable power generation, grid connections, water intake and treatment, compression, storage, pipelines, loading terminals, and transport infrastructure. Additional investment may be needed for ammonia synthesis, fuel production, refueling stations, and modifications at the customer facility. End uses include refining, fertilizer, steel, methanol, shipping fuels, and export markets. This explains why project costs can be so large and why investors scrutinize the full system rather than one equipment package. A hydrogen plant becomes bankable only when the complete value chain, from renewable electricity to the final customer, can operate reliably. Government capital often enters at the earliest and riskiest stages. Grants and technical assistance can support pre-feasibility studies, feasibility work, environmental assessment, project design, training, and institutional development. Subsidies, tax incentives, auctions, and production support can also help close the gap between the cost of low-emissions hydrogen and the price customers are willing to pay. Public support is especially valuable when a project has strategic benefits, but is not yet ready for commercial debt. However, public funding increasingly comes with milestones, delivery deadlines, and verification requirements. Governments are moving away from open-ended support and toward mechanisms that reward credible projects, measurable progress, and actual production. Development banks and climate funds help bridge the space between public policy and commercial finance. Their role can include project preparation grants, technical assistance, concessional loans, guarantees, blended finance, and early development capital. Institutions such as the World Bank, IFC, EIB, EBRD, African Development Bank, and Green Climate Fund can help reduce risks that private investors are unwilling to carry alone. They typically examine development impact, environmental and social standards, government alignment, climate additionality, and the path to financial close. Their involvement can improve credibility, but it does not eliminate the need for a strong project. Sponsors still need realistic costs, permits, infrastructure planning, and a believable market. Strategic corporate investors contribute more than money. Energy companies may bring project development experience and access to customers. Industrial off-takers can provide demand, operating knowledge, and long-term purchase agreements. Technology companies may contribute equipment, warranties, performance guarantees, and service capability. Project sponsors provide leadership, equity, and responsibility for execution. These investors are particularly valuable because they understand the industry in which the hydrogen will be used. Their participation can signal that the project has a practical commercial purpose. But strategic investment also requires alignment on control, pricing, technology selection, risk allocation, and long-term strategy. A credible partnership must clearly define what each organization contributes. Commercial banks and infrastructure funds generally enter later than governments, climate funds, or development institutions. They prefer projects with completed engineering, secured permits, credible construction arrangements, and contracted revenue. Banks focus on debt service capacity, sponsor strength, counterparty credit, insurance, and the allocation of construction and operating risks. Infrastructure funds look for predictable long-term cash flow and protection against downside scenarios. A project may have strong renewable resources and attractive technology, but still be unsuitable for private finance if its customer agreement is weak or its permitting path is unclear. Private capital usually follows bankability. It rarely creates bankability from an early concept without substantial risk protection. Most bankable hydrogen projects use several forms of capital rather than relying on one investor. Grants and technical assistance can fund early studies. Sponsor equity demonstrates commitment and absorbs development risk. Concessional debt can reduce financing costs and extend repayment periods. Commercial debt provides larger construction financing once risk has been reduced. Guarantees and export credit support can protect lenders against political, credit, procurement, or completion risks. Production incentives and contract for difference may strengthen operating revenue. The financing stack changes as the project advances. Early stages rely on flexible and risk-tolerant capital, while later stages can attract lower-cost institutional finance after the project has secured permits, engineering, and offtake. Capital intensity differs sharply across regions. Europe has relied heavily on auctions, production support, and policy-backed revenue mechanisms. China combines large-scale manufacturing with domestic industrial deployment. The United States has attracted investment through incentives and support for both electrolysis and hydrogen linked to carbon capture. The Middle East and Australia have emphasized large export-oriented projects. India is connecting hydrogen development to industrial demand, refining, and fertilizer. Latin America offers strong renewable resources and opportunities in ammonia and fuels. Africa has major resource potential, but many projects still require development capital and infrastructure. Regional opportunity therefore depends not only on renewable resources, but also policy, demand, finance, and execution capability. The track pipeline is geographically broad. Australia has the largest announced capacity in the database, followed by countries including Mauritania, Brazil, the United States, India, Egypt, China, Chile, Spain, and Oman. But announced capacity is not the same as committed capital. Spain, for example, recorded a large number of projects, while several countries have very large proposed developments concentrated in a smaller number of export concepts. The key lesson is that pipeline scale can indicate ambition, but not necessarily financial maturity. Capital becomes more concentrated, where sponsors can combine policy support, infrastructure, credible customers, and a realistic route from feasibility through construction. Europe has created one of the world's most structured policy environments for low-emissions hydrogen. Instruments include the European Hydrogen Bank, Innovation Fund grants, national subsidy programs, auctions, contract for difference, and production link support. These mechanisms are designed to provide revenue certainty and help projects compete against conventional hydrogen. But support is increasingly conditional. Winning an auction does not automatically mean the project has reached financial close. Developers may still need to meet deadlines, secure permits, complete financing, and prove production. Europe therefore demonstrates both the power and the limitation of policy. Public support can accelerate bankability, but it cannot replace strong execution, disciplined bidding, and credible industrial demand. China's position is driven strongly by scale. Large manufacturing capacity, integrated industrial supply chains, and domestic deployment have supported rapid expansion of electrolyzer production. This can lower equipment costs and accelerate delivery, especially where manufacturers have access to steel, power electronics, engineering capacity, and established industrial customers. China also leads committed electrolysis capacity in the report's assessment. However, manufacturing scale alone does not guarantee that every hydrogen project will operate economically. Utilization, renewable electricity cost, integration, and end-use demand remain critical. China's model shows how industrial policy and manufacturing capability can move capital toward equipment and deployment at the same time, creating a different investment pathway from subsidy-led markets. Africa has some of the world's strongest renewable resources, and several major announced hydrogen and ammonia projects. Yet early-stage development capital remains scarce. Many projects need funding for site studies, feasibility, environmental and social work, water assessment, grid and port planning, engineering, permitting, and offtake development. Without this project preparation work, large resource potential cannot become bankable infrastructure. Development banks, climate funds, and specialized project preparation facilities can play a critical role. The challenge is not simply raising billions for construction. It is financing the smaller but essential steps that prove a project is viable. Africa's opportunity depends on converting renewable potential into verified evidence that investors can underwrite. Investor interest is strongest where hydrogen connects to an existing industrial customer. The project database shows substantial activity around ammonia, fertilizer, refining, methanol, steel, synfuels, and shipping. These sectors already consume hydrogen or require molecules that could potentially be produced using renewable energy. Existing demand reduces the need to create an entirely new market. It can also provide clearer volume requirements, product specifications, and infrastructure connections. This does not make every industrial project bankable, but it gives investors a more credible commercial foundation than an export concept with no confirmed buyer. Capital follows real customers because demand, price, and contract duration determine whether the project can generate dependable revenue. Green ammonia is receiving significant attention because it connects renewable hydrogen to established markets. Ammonia is already used extensively in fertilizer production and can be stored and transported more easily than pure hydrogen. It also has potential applications as a shipping fuel, energy carrier, and industrial feedstock. This creates multiple possible revenue pathways. Projects can be connected to domestic fertilizer demand, industrial customers, or export terminals. Investors still require competitive costs, certification, reliable renewable power, and credible buyers. But ammonia can offer a clearer route to market than an undefined hydrogen export proposal. Its existing infrastructure and customer base explain why it frequently appears among the largest announced and financed hydrogen-related developments. Offtake is the bridge between technical ambition and financeable revenue. An industrial buyer demonstrates that there is real demand for product. A long-term contract then establishes volume, pricing, duration, quality requirements, and delivery conditions. If the customer is creditworthy and the contract is sufficiently strong, lenders can use the expected cash flow to assess debt repayment. A letter of interest may support early development, but it is not equivalent to a binding agreement. Projects normally progress from customer discussions to letters of intent, memoranda of understanding, pilot supply, and eventually bankable offtake. Without contracted demand, even technically advanced projects may struggle to attract construction finance. Hydrogen projects move through a sequence of development stages. The concept stage establishes a use case, site and initial demand thesis. Feasibility tests renewable resources, electricity, water, logistics, costs, and market assumptions. FEED develops the engineering basis and construction strategy. Permitting secures land, environmental approvals, and operating rights. Offtake converts market interest into contracted demand. The financing stage combines equity, grants, debt, and risk mitigation instruments. Financial close occurs when agreements are executed and key conditions are satisfied. Construction then transforms the design into physical infrastructure, followed by commissioning and operation. Each stage reduces uncertainty and creates the evidence required by the next group of investors. Projects rarely fail because of one issue alone. Offtake may be uncertain, renewable power may be too expensive, or permits may take longer than expected. Grid access, water, ports, pipelines, and storage may be unavailable. Certification rules can change. Subsidy decisions can be delayed, and interest rates can increase. Engineering may be incomplete. The sponsor may lack sufficient equity, or contractors may be unwilling to accept performance risk. These barriers interact. A permitting delay can increase cost, weaken the construction schedule, and cause a customer to reconsider its contract. Capital stops when too many risks remain unresolved. Successful developers therefore manage commercial, technical, financial, regulatory, and execution risks together. This distinction is central to credible capital intelligence. An announcement describes intention or projected project value. Approval means a board, government, or program has authorized support, often subject to conditions. Commitment generally indicates that financing has been legally or contractually allocated. Financial close means a financing package has been executed and key conditions for drawdown have been met. Disbursement is the actual movement of money. These stages must not be added together as though they represent separate investments. The same project may appear in several announcements as it progresses. Accurate tracking requires one transaction record. Clear status labels, original sources, and evidence showing how far the capital is moved. Several examples illustrate different stages of real capital movement. The European Hydrogen Bank has awarded production support, but payments depend on signed agreements, maturity, and verified output. Atome's Valletta Fertilizer Project combines institutions, including IFC, GCF, IDB Invest, EIB, and FMO, in a layered financing structure. The Churchit Project in Uzbekistan uses EBRD and concessional climate finance. Coega Green Ammonia in South Africa has development funding with the possibility of later construction equity. Hyphen Namibia received project preparation support for FEED and bankability. These examples are not identical. Some represent grants, some development capital, and some debt. Their status must be described precisely. Over the next 2 to 3 years, 3 broad pathways are possible. The base case is selective growth, with stricter diligence and capital concentrating in China, Europe, India, incentive-backed U.S. projects, and development finance-supported projects in emerging markets. An accelerated case would require lower costs, clearer regulations, stronger demand, and more binding offtake, potentially increasing final investment decisions in ammonia, refining, e-fuels, steel, and port infrastructure. A downside case can emerge if interest rates remain high, demand weakens, or subsidy implementation slows. In that environment, capital would retreat toward projects supported by strong corporate balance sheets, governments, and development institutions. Policy, cost, demand, and execution will shape the outcome. The hydrogen market produces many announcements, but far less verified information about financial close, disbursement, cancellation, and project stage progression. Developers need to know which investors are genuinely active, what financing instruments they offer, which stages they support, and what requirements they impose. They also need visibility into changes, whether a project has moved from approval to commitment, whether a financing agreement became effective, or whether a deadline was missed. Public databases, company announcements, and development bank portals contain valuable information, but it is scattered and inconsistent. The missing layer is a system that normalizes the information, preserves the source, and distinguishes ambition from actual capital deployment. H2 Hub Capital Intelligence is designed to become that verification and decision layer. The proposed platform combines a transaction tracker, investor database, funding opportunity monitor, project readiness assessment, and investor matching capability. It would separate announced, approved, committed, financially closed, and disbursed capital. It would show investor mandates, ticket sizes, geographic preferences, and project stage requirements. Developers could compare transactions, identify suitable capital providers, and understand what is missing before approaching them. The strongest initial product is a verified transaction and financial close tracker, supported by investor profiles and funding alerts. The final message is simple. Follow the money, verify what is real, and use that intelligence to build more bankable projects.